We have so much credit now. This credit bubble has just grown and grown and grown. And we are now, as we speak, facing a crisis in the bullion market. And that crisis, I think, marks the end of the fiat currency system, which came out of the end of Bretton Woods. You know, in the case of financial instruments, of course, it's just credit, 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 no delivery. But then we get into a different problem, and that is that the higher the price of gold rises, you'll find that some banks are going to get into trouble because they are short of gold or paper gold in the form of futures or forward contracts in London, or options in either market. So that then becomes the next significant worry, which could drive this even further.
Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pinned comment. Stay ahead of the curve. Don't miss out.
Since COVID, and particularly since 2021, I've started tracking this daily, there have been what are called stands for delivery. And these have been mounting. Now, so far, in the last 4 years, the amount stood for delivery is around about 2,200 tons of gold. Now, bearing in mind that, this is, 2,200 tons is a hell of a lot of gold.
That is about,
really
10% of actual gold reserves in central banks worldwide.
Yeah. Now, the story gets a little more complicated here because if you stand for delivery, it's actually quite a complex process. In order to secure your gold, you've got to do two things. Firstly, you've got to persuade someone to deliver it to you. Now, under the rules, you can do that. But you find that people are very reluctant for you to do so. There are instances where small traders have been threatened. Look, if you want delivery, you'll never deal in this market again. No, that's anecdotal. Only 2 days ago, there was a fascinating article published on the Garter website, which is the gold anti-tariff action group, or whatever they call it, which actually is a very, very good source of information on the market, whereby an individual who was a dealer for Sprott, which was one of the big Canadian buyers, and managers, if you like, of a silver trust. They bought a lot of silver through futures and stood for delivery. This was meant to be a 5-day settlement. It took them 9 months to get that delivery. So many hurdles were placed in the way to discourage the delivery. Now, the other thing is there is a difference between, let us say, a bullion bank recognizing that you have taken delivery and it actually leaving the Comex vault. The bullion bank reckons, yeah, okay, we finally agreed, you can take your 100 contracts, 1,000 contracts, whatever it might be of gold. We turn that into bullion. 1,000 is 100,000 ounces. Okay, you've got 100,000 ounces. We'll look after it for you. And here's a piece of paper that says that we're looking after it for you. Is it there? No. All you have got is a credit. We're coming back to the, the definition of what's money and credit. You've got a credit. In other words, the bullion bank has an obligation to deliver to you 100,000 ounces of gold. Does it actually have it? Not necessarily. Now, we get back to where we are today. Trump gets elected on the 5th of November. Foreigners dealing through Globex in particular don't like the idea of a Trump presidency. They know he interferes. He turns around on a dime and says, he changes everything like that. So where's the certainty in your possession or a bullion bank holding your gold and owing it to you in Comex? Well, the answer is that certainty has taken a big dive downwards. So what do? I want physical. I want it now. That's what they're saying. And this is the run that's occurring on Comex. And not only this is on Comex, but it's sucking in gold from everywhere. The mechanism by which it sucks it in is that the futures trade at a significant premium to the spot price. So an arbitrage starts where people will buy spot in London, say, and then ship it to New York, and they'll strip out 15%. Nice money if you can do it. And it just goes on an aircraft. Boom. Okay. They've cleaned out the liquidity in the London commercial vaulting system, the London Bullion Market Association vaults. They're queuing up at the Bank of England. The queue, we're told in a Financial Times article a week ago, is up to 8 weeks long. Now, a lot of that gold, just to make it worse, a lot of that gold is leased off central banks, I would think, because the Bank of England does store gold for commercial entities, but not very much, certainly not enough to have a queue lasting up to 8 weeks to get delivery of bullion. Leasing is a slightly separate issue. I won't go into that. But I mean, the important point is that, gold is being stripped from everywhere. And then Reuters reported, I think it was yesterday, that even gold in India, because basically there's tax on gold in India. So what importers do is they hold it, if you like, outside the country, but in customs warehouses. So they don't have to pay the tax until they draw down on it. The stocks in those warehouses are being moved out into America, taking advantage. So they are cleaning out all the liquidity in the world at a time when there is absolutely nothing available. And that's why you're seeing the price soar, literally. I mean, it's just rising and rising and rising.
According to the World Gold Council, between 2014 and 2024, it more than doubled its gold holdings, indicating that its strategy of diversifying its international reserves had started before the trade war. In the explosive interview, Alasdair Macleod explains that central banks, including those in BRICS nations, are increasing their gold reserves in response to rising risks in fiat currencies and geopolitical uncertainty. He notes that India, historically anti-gold under previous governments, shifted its stance due to its closer alignment with Russia and China. Furthermore, Macleod emphasizes that India is balancing its Western economic ties while recognizing that its future lies with the Asian hegemons, leading to a more gold-friendly policy, including easing gold import taxes for its citizens. Gold demand in India witnessed a 5% on-year rise at 802.8 tons in 2024, supported by a reduction in import duty and purchases related to weddings and festivals. And going ahead, consumption of the yellow metal in 2025 is likely to be between 700 to 800 tons, according to the World Gold Council.
Simpler than that in the case of many of the central banks. What they're doing is they're adjusting their reserves for their perception of changing risks. I think they do understand that gold is money and the rest is credit. They might not put it quite as bluntly as that. But if you're running, a reserve position and you've got, say, dollars and euros and, maybe a few other currencies, and you're looking at that and you're sort of thinking, well, there is actually mounting risk here because, we can see that inflation has sort of picked up again in these countries, and we can see that the dollar might be over-owned, and we can see the geopolitical thing. There's probably a bit too much risk in having all our eggs in those baskets. So I think the purchase of gold as part of the reserves makes a lot of sense from that point of view, and from the central banker's point of view, which is obviously what's driving it. You mentioned India. I mean, India, I think, is an interesting one because India under Mamazar Singh, was that his Christian name? I probably got it wrong. Was very much Keynesian, and so anti-gold. They always didn't like the fact that Indian citizens were buying gold and used gold, if you like, as wealth. They would deploy it, sort of. If you need to buy seed for the following year's crop, you probably pawned some gold in order to do it. And this was gold bangles which your wife wore, and you have to persuade her to part with it. So, there was a system that, as far as the peasantry was concerned, really worked. And there was this understanding amongst everybody, apart from government, that gold actually is the superior form of money. But so government has always turned its back on gold. Now, this changed basically with the rise of the two Asian hegemons, particularly Russia, to whom India has always traditionally been quite close, and China. And with India's move, and this was planned for some time before it actually happened, move into that sort of orbit. BRICS being brought up, India is the eye in BRICS, also the Shanghai Cooperation Organization. India was really moving away from the West in terms of its influence and monetarist approach into that of the Asian hegemons. it's walking a tightrope on this because it does a lot of business in the West and doesn't want to upset the West. Furthermore, of course, virtually every emerging nation knows that if you upset the Americans, they either call in their loans, and you've always borrowed dollars, and they can bankrupt you very quickly, or alternatively, they organize regime change. So, from all these BRICS members' point of view, they're all being very, very cautious. They're sitting on a fence, trying not to upset one or the other. But they can see their future is not with, the Western alliance. It's actually with the Asian hegemons. And China and Russia have accumulated quite a lot of gold. They're also major gold miners. So India has to go along with that policy. And that's basically why she has turned round on gold from being completely anti it into accepting it and letting the brakes off a little bit in terms of tax on gold imports for its citizens.